If this is your first time on the channel and you want to know everything there is to know about living in Redondo Beach, California and the surrounding South Bay area, then hit subscribe so you can stay current in what's happening in Redondo Beach. My name is David Coe. I have lived in Redondo Beach for over 30 years and been a realtor for the last 20. Myself and my team at the Coe Real Estate Group, we love to help people navigate the move here to Redondo Beach. And whether that's 9 days or 900 days away for you, we would love to be connected with you. All of our contact info is in the description, and we'd be happy to help you make a smooth move to Redondo Beach or the South Bay area. Hey everyone, David Coe, the Coe Real Estate Group. Hey, welcome back to our channel where we talk about all things about living and owning real estate here in the South Bay. You know, one of the things that's really common in our community is we have a lot of people that are self-employed, myself included. Danny, maybe you, are you self-employed?
Technically W-2, but do some contracting as well, yeah.
All right, yeah. I guess technically I'm also W-2, but it's all based off of my self-employment work. But I think there's a lot of misconceptions out there from people that if you don't have a W-2 job or if you haven't had 2 years in business that you can't qualify for a loan. And that is not true. And today I've got Danny Waddell back with Cross Country Mortgage. Danny, if you might remember, is a lender. We talked a lot about with Danny last time about what to do if you don't have a lot of a down payment and different options you may have. Well, today we're going to take a little bit of a different conversation. We're going to talk about what if you do have income, but it's not traditional W-2 income, and what kind of programs are out there, both for people that want to buy a home for their personal residence as well as for investors. So Danny, thanks for coming back again.
Thanks, Dave, for having me. I think it's really important to touch on these topics because in LA, where you and I live, primarily here in the South Bay, everybody has unique income. Very rarely someone just like a W-2 wage earner and that's all they got, right? Like they own a little bit of their family's farm in Nebraska. They have a little bit of trust. Like everybody's side hustling too to figure out a way to live here and live here well. So I think this is such a timely topic.
All right, well, look, first of all, let's just jump right into it. I mean, you know, I think if you went to a traditional bank and you didn't have W-2 income, they might say we could take 1099 income, but you have to have 2 years of tax returns. And like you say, there are a lot of people that have 1099, have K-1, have different kind of revenue. So what are some of the programs that you have? What are some of the tools you have as a lender where you can help those people buy a home?
Yeah, you know, oftentimes we get clients that have consulted with a big box bank or depository bank and they've gotten rejected. They're been told they don't qualify because their tax returns don't reflect income. And traditionally, and for conventional financing, they're just looking at your tax returns. But if you have a good CPA, right, a good CPA's job is to not show much income so you're not paying as much taxes. So how can we help you qualify for a house when those measures and marks aren't being met? So with cross country, you know, we do all types of different loans to help those clients specifically. If you're a small business owner, instead of looking at your tax returns for a declared income, we can look at your bank statements. As long as you have 12 months of bank statements, we'll use the deposits going into that account as qualifying income. We average it over 12 months. We also have other programs that are just looking at your P&L or your balance sheet, and we'll use that as income. There's just so many different ways that we can look at specifically self-employed borrowers to help them qualify for a home. And I do that stuff all the time. It's one of our more powerful programs that we have for small business owners.
Yeah, you know, it's funny. I love the bank statement loans, but sometimes self-employed people will write off a lot of expenses and actually reduce the amount of money they're making on paper. Is that something where a bank statement loan can help you get around that, where you can really focus on the gross income, not the net income of the business?
Exactly. For bank statement loan programs, we don't even ask for tax returns. I don't want to look at them. I don't want to see them. I don't want to know about them, right? That's whatever you do is between you, your CPA, and the IRS tax god. I only will ever ask in that situation for the most recent 12 months of bank statements, and then I'll average deposits going into that account as your qualifying income. For P&L loans, similarly, we look at the profit and loss over the last 12 calendar months, and we divide that by 12, and that's your income. So I'm not really looking at how much your write-offs are, how much you're W-2ing yourself or K-1ing yourself, or however you're just, you know, taking distributions from the company. I'm not looking at any of that. I'm just looking at your percentage of ownership, how much money you got going into the business, and does that qualify for a loan?
What kind of premium is associated on those loans? I mean, we are in a higher interest rate environment, but I'm assuming if I am W-2 and I've got an 820 credit score, I'm going to probably get a bit of a better rate versus if I am using a bank statement loan. Like, what would you say is the average spread right now between those products?
Yeah, great question. I get that a lot. And it's honestly not what you think it is. The spread is not very much at all. The bank sees these as very secure lending practices. And so it might be an eighth or a quarter of a percent difference from a W-2, especially if it's a strong borrower putting 20% down with good credit, all other qualifying ratios are met, then you're going to get a good rate. You're definitely going to get a good rate.
That was actually my next question is, do I need to have 20% down? And it sounds like I don't, but obviously the more I put down, the better rate I'm going to get.
Yeah, we can go as little as 10% down with some of these more non-conventional qualifying products. But the interest rates are going to be more optimal if you're at least putting 20% down when we're doing a alternative document qualifying loan program.
I know another situation we run into is we have people who actually have no income, but they have assets, right? They might
Yeah.
own a retirement account. They may have a stock account, or just, they have wealth. They just don't have income. What can you do for those kinds of borrowers?
Yeah, great question. Here in LA, especially for retired individuals that have a lot of retirement assets, but they're not going to use them necessarily for the down payment and closing costs on a home, but that is what they're going to be living on for the foreseeable future is just their 401ks, their IRAs, their, anything like that. So what we can look at in those cases are asset qualifying loan programs. Again, I'm not looking at tax returns, although I can pair W-2 income with asset qualifier to help someone qualify for more. I'm actually working with a client right now, very similar. They're a W-2 wage earner and they have substantial assets that when together I combined their asset qualifying income with their W-2 income, it helps them qualify for a much bigger home, but it's not required. What I can do is look at their assets and then do some fancy calculations to find out what the bank would use as qualifying income to help them qualify for a home. So again, you don't have to use the W-2 traditional income as long as you have necessary assets and other ways that we can help make it make sense to the bank that you can qualify and pay for this mortgage. We can get the loan done.
That's a good question about what if you've got one spouse who's a traditional W-2 and one who's self-employed? Like in those situations, is it a matter of just which spouse qualifies for more, or can you somehow combine them in one loan?
Both and. So that's another good point. So oftentimes with W-2 wage earners, we don't look at tax returns very often if it's a conventional type of W-2 wage earner. If they don't have ownership in other properties, anything like that, we don't necessarily need we don't need tax returns. But when we are combining W-2 income with some of these alt-doc loan program incomes, we can absolutely merge those two together to help them qualify. We can use the entire household income to help them qualify for the home that they love. So there are creative ways that we can make sure that it works for the borrower.
So far, mostly what we've talked about are people that are buying a primary residence, a home they want to live in. But what if I'm an investor? Maybe I fall in one of the buckets we just discussed, but I'm looking to buy investment property. Are there different kinds of loans I can use for that situation?
Yeah, that's a great, yeah. And here in LA, a lot of people do investment in house hacking and all kinds of cool ways to really get involved in real estate. So one of the more powerful programs, again, we're talking about not using tax returns, like that's kind of the strategy of our conversation today. One of the easiest ways for an investor to buy an investment property is called a DSCR loan program, which essentially, as long as the rents that are coming in from the property, as long as that's enough to float the loan payment, the property taxes, and the homeowner's insurance, it qualifies. That's a really powerful program. I kind of call it my appraisal only because all I need is an appraisal on the property and then we're done. I'm not asking for tax returns. I'm not asking for borrower docs. Generally, they'll want to see some asset statements to make sure that you have enough reserves in your checking and savings and retirement accounts to float the property if you needed to. So we are going to want to see post-closing reserves. But the DSCR loan program is a really powerful one that helps investors really easily and quickly purchase an investment property. As long as the property itself floats itself, then it qualifies and we can close very quickly and very easy.
Now, I know for a loan like that to apply for DSCR, you probably have to put at least 30% down, 40% down to hit the ratios with our price to rent ratios here in LA.
Yeah, that's a really good point. Here in LA, a lot of our pricing is very high. So therefore, the monthly payment on these loans are generally higher as well. So we want to make sure that the ratios work. And so they are wanting usually to see around 25 minimum percent down or more. But to get these ratios to really work in LA County, what we're seeing is usually around 30, 35% down.
Which honestly, even if you're using traditional financing, that's safe debt, right? That's like strategic use of debt. It's not being reckless with debt, which, I think a lot of what's happening right now in the larger multifamily sector is they were over leveraged. And when interest rates went up as quickly as they did, they didn't have that equity position to kind of fall back on. So,
Yeah.
buying property like that rental property in Southern California, putting more down makes more sense anyway.
And what I'm seeing right now is diversification. A lot of people that are are highly invested in one specific stock option, whether it's with their company. What they're wanting to do is diversify their portfolio. So like, for example, I just had a client with Google who their financial advisor said, "Listen, you've got too much stock in Google. I need you to go buy properties to diversify your portfolio." Especially with the SpaceX going public and IPOing, we're seeing a lot of SpaceX people wanting to get into the investment market. So all of these types of liquidity events are helping people really diversify their wealth and sustain themselves for longer periods of time.
Yeah, look, and beyond growing wealth, it also has huge tax advantages, right? So there are just certain things that you can get out of real estate that are a part of a diversified portfolio.
Yeah, that's a great point.
Yeah. All right, Danny. Well, hey, I appreciate it. Thanks for coming on. Again, look, if you're out there, you don't have traditional W-2 income and you are self-employed, but you're making enough money to buy a house. There are loan programs out there for you. Please feel free to contact myself, contact Danny. We're going to have his information down here. And, let's help you find a property with the right financial product. Danny, thank you so much for coming on today. I appreciate it.
Yeah, thanks so much for having me. Looking forward to helping these clients, get these homes that they love. So thank you for having me.
All right, Danny. Hey, thanks everyone. If you like this, please hit the subscribe button below. We're doing all kinds of great content for people that are looking to own and buy real estate here in the South Bay. David Coe with the Coe Real Estate Group. I'll see you next time.